Welcome back to Financial Accounting in the final section of Chapter 2. I've referred throughout our discussion to the story we write about a company using the language of accounting. In this presentation, we will talk once again about financial statements, which are the final, formal, edited version of the story we are communicating to our financial statement readers. This video will discuss how to prepare the financial statements using the trial balance and also introduce you to the debt ratio. We ensure the general ledger is in balance by preparing a trial balance. The trial balance is a list of all the accounts in our general ledger and their related balances. If an account has a zero balance, list it with a zero in its normal balance column or omit it entirely. Notice here there is no retained earnings account yet. The trial balance always shows the balance in retained earnings at the beginning of the year. Because Fast Forward started business in 2015 and the company has not closed their books for 2015 yet, retained earnings is still zero. We will talk about this more in Chapter 3. I just want you to understand this point because it is confusing to students. The trial balance shows the retained earnings balance at the beginning of the year. Notice that the total of all our debit account balances must equal the total of all our credit account balances. If this is not the case, we may have made an error posting the journal entry to the ledger. However, equality of these two totals does not guarantee that no errors were made. For example, the column totals still will be equal when a debit or a credit of a correct amount is made to the wrong account. I have provided a handout to you to illustrate common posting errors. The point is, we cannot prepare the financial statements until the books are in balance and amounts correctly reflect all transactions. If the trial balance does not balance, the errors must be found and corrected. We have listed 6 steps for you to follow when your trial balance is out of balance. Essentially, to find an error, you must trace your step backwards from the trial balance to the general ledger to the general journal, ensuring that you followed every step properly. You may wish to refer back to the screen if you run into trouble with your homework. Please ensure you understand the purpose of each of the 4 financial statements. Your textbook provides good information about each of them. Fast Forward's income statement for December is shown on this slide. Information about revenues and expenses is conveniently taken from the trial balance. Net income of $3,395 is reported at the bottom of the statement. Owners' investments and withdrawals are not part of net income. First, please notice on this formal financial statement that there is no debit and credit information. The columns depicted here are simply columns. They are not meant to communicate debit and credits. Why? Because our financial statement users don't use accounting language, so they never use it on financial statements that are formal. Now let's look at the income statement or the scoreboard. Here is the information for Fast Forward for the month ended December 31st, 2015. Remember, the date is critical. We don't want our financial statement readers to think it covers a full year. It's only for 1 month. The company had total revenues, that's the good news first, of $6,100, and total expenses, that's the bad news, second, of $2,705. For the month, Fast Forward generated $3,395 in net income. We can look back at the trial balance to verify the amount shown on the income statement. Fast Forward statement of retained earnings is the second report in this slide. The beginning balance in retained earnings was zero because the company started on December 1st, 2015. It earned income of $3,395, and during the month, dividends of $200 were paid. The ending balance in retained earnings is $3,195. This amount will appear in the equity section of the balance sheet as well. As a side note, Next month, January 1st, the beginning balance in retained earnings will be $3,195, which is December 2015's ending balance. In other words, the ending balance in an account for the first month becomes the beginning balance in the account for the next month. Let's look at Fast Forward's balance sheet now. This statement refers to the financial condition at the close of business on December 31st. The left side of the balance sheet lists its assets at $42,395. The upper right side of the balance sheet shows that it owes $6,200 to creditors and $3,000 in services to customers who paid in advance. That's that unearned consulting revenue. The equity section shows an ending balance of $33,195, which consists of the common stock account of $30,000 and the retained earnings account balance of $3,195, taken from the ending balance of the statement of retained earnings, which was prepared earlier. The accounting equation is in balance because assets are equal to liabilities plus equity. There are many common standards for formatting in accounting. Please review the presentation issues outlined in your textbook and on this slide as you prepare the financial statements. You'll notice that we discuss different financial ratios in every chapter. The final topic of Chapter 2 is the debt ratio. Ratios allow us to compare a company's performance from one year to the next or to a competitor. After all, numbers are simply data. They don't mean anything unless you can compare them to another number. Only then do numbers become information. So remember the accounting equation, assets equal liabilities plus equity? The debt ratio tells us about the relationship between liabilities and assets of the company. In other words, it quantifies how much of a company's assets are financed by lenders as opposed to owners. The debt ratio is used to measure the risk that a company will not pay back the amounts it owes to its lenders. It shows us how many dollars of debt exist for each dollar of assets owned by the company and is equal to total liabilities divided by total assets. A higher ratio indicates there is greater probability that a company will not be able to pay its debts in the future. Holy smoke, we covered a great deal of material in this chapter. Good job. The new terms and their meanings will be reinforced by your homework. It's probably a good idea to start on your homework while this presentation is still fresh. If you have difficulty with the material, consider reviewing the comprehensive need to know near the end of the chapter in your textbook. You can also review the practice materials that are available to you in Connect. Please let me know, as always, if you need help with the topics we discussed in these presentations. And thanks for being my students. Have a great week.